When you get an insurance payout, do you really win, or does the insurer still come out ahead? The answer lies in the little-known concept of indemnity profit, and it's a lot more surprising than most policyholders think. Today, we're unpacking it from both sides, the insurer's balance sheet and your pocket. Welcome back to Insurance World TV, where we break down the big ideas in insurance so you can understand them, apply them, and win with them. Today we're tackling a topic that sounds technical, but trust me, it affects every single claim you've ever heard of. That is indemnity profit. Who really benefits when a claim is paid, the insured or the insurer? We're going to break this down from both sides, the insurer's balance sheet and your bank account. By the end, you'll see why this concept is not only misunderstood, but also surprisingly revealing about how the business of insurance truly works. Topic 1. The hidden windfall. Alright, let's start with something that might raise a few eyebrows. Is it possible to actually make a profit from an insurance claim? In other words, can your payout ever be more than your actual loss? That's what we call indemnity profit, and while it sounds like free money, the reality is far more layered. First, let's break down the words. Indemnity simply means restoring you to the financial position you were in before the loss happened. No better, no worse. Profit, on the other hand, is anything you get over and above that. In insurance, that extra bit is controversial and, in many cases, not even supposed to happen, at least in theory. But here's where it gets interesting. In the real world, certain factors, like depreciation calculations, replacement cost policies, or even favorable exchange rates, can tilt the balance in your favor. And that's not just about your wallet. These situations have ripple effects across the entire insurance industry, influencing pricing, underwriting, and even fraud prevention strategies. So, let's lift the lid and see exactly how indemnity profit can appear and why insurers are so keen on keeping it under control. How indemnity profit slips through the cracks. In a perfect insurance world, payouts would match your actual loss down to the shilling. But in the real world, a few loopholes, some intentional, some not, can create that little extra. Here are a few of such instances. First, replacement cost versus actual cash value. If your policy pays for replacement cost rather than the depreciated value, you might get brand new items even if your old ones were well used. That's like trading a 5-year-old TV for the latest model without paying a cent. Number 2. Favorable market shifts. Suppose your car is written off and you bought it when prices were low, but now secondhand values have shot up. If the payout matches current market value, you could walk away with more than you originally spent. Third, currency exchange gains. For imported goods or assets valued in foreign currency, a change in exchange rates between purchase and claim settlement can boost your payout. Fourth, over-repair or upgrades. Sometimes repairs are done in a way that improves the item beyond its pre-loss state, like replacing a damaged kitchen countertop with a more expensive material, all covered by the claim. While these situations might feel like a bonus for you, insurers see them as leaks in the system, and leaks add up. If left unchecked, they can lead to inflated claims costs, which eventually ripple through to higher premiums for everyone. Topic 2. The insurer's perspective, why indemnity profit is a red flag. From the insurer's side of the table, Indemnity profit isn't a happy accident, it's a warning sign. Remember, insurance is built on the principle of indemnity, restoring, not enriching. If payouts routinely exceed the actual value of losses, it can throw the entire balance of the business off course. Why? Because insurers operate on a carefully calculated equation: premiums in, claims out, and enough left over to cover expenses and future risks. When indemnity profit creeps in, whether through overvaluation of damaged property, underestimation of depreciation, or even inflated repair costs, that equation starts to crack. And here's the kicker. If it happens too often, it doesn't just hit the company's bottom line, it can impact every policyholder. Higher than expected payouts force insurers to raise premiums, tighten underwriting rules, or cut back on certain coverages. From their perspective, preventing indemnity profit isn't about being stingy. It's about protecting the sustainability of the entire risk pool. And that's why they invest so heavily in adjusters, appraisers, and data analytics to keep payouts aligned with actual losses. Topic 3. The insured's perspective: payout or profit. From the policyholder's point of view, getting a payout that's higher than your actual loss might feel like hitting the jackpot. But before you start celebrating, there are some important realities and even risks to consider. First, there's the ethical side. Insurance is a shared pool of risk, funded by everyone's premiums. If you knowingly accept more than your actual loss, that excess isn't free money, it comes from the collective pot. Too much of that happening, and everyone ends up paying more in the long run. Then there's the practical risk. If your insurer later discovers that the payout exceeded the real loss, say, because of missing depreciation data, inflated repair quotes, or overlapping cover from two policies, they may ask for a refund, deny future claims, or even cancel your cover. In the real world, unintended indemnity profit can sneak in through the following channels. 1. Undervalued loss estimates. Maybe you underestimated the loss in your initial claim, and when the final settlement is calculated, it comes out higher than the true cost to restore. 2. Overlapping policies. For example, both your homeowner's policy and a gadget insurance policy covering the same laptop. Each might pay out, creating a double benefit. 3. Policy gaps in wording. Loopholes in the contract that unintentionally allow an upgrade or extra benefit. So, what is the safest path? Keep detailed records of your assets, document losses accurately, and communicate openly with your insurer. This ensures your settlement is fair, transparent, and free from complications down the line. Topic 4. Real-world impact. Case studies. Example 1. Rare car claim settlement. A policyholder had insured a rare Toyota Saloona. After being rear-ended, the boot was severely damaged. The insurer approved a rear-cut replacement, but the repairer couldn't source the parts and return the job. As a result, the insurer opted for a contract repair settlement, paying the policyholder half the car's value, treating the vehicle as a total loss, allowing them to keep the salvage, and closing the policy. Later, the policyholder sourced the required rear cut from a cheaper supplier at about 1/5 of the original cost, completed the repairs, took out a new insurance policy, and still retained a surplus from the original claim payout. Example 2. Replacement of older model car parts with newer model parts. An older car is damaged, but the exact spare part for that model no longer exists. The repairer finds that a newer model part is fully compatible, and the insurer authorizes the replacement. While this restores the car, the newer part may be of higher quality or value than the original, effectively upgrading the vehicle. If the insurer pays the full cost, but the insured later sources the part cheaper, the difference can turn into indemnity profit. Here are other instances where indemnity profit can arise. 1. Currency exchange gains in imported equipment claims. A business insured an imported industrial machine in USD. After a fire damaged the equipment, the insurer settled the claim based on the prevailing exchange rate, which had risen significantly since the original purchase. When the insured imported a replacement at a lower exchange rate or from a cheaper source, they retained a surplus, creating indemnity profit.
2.
Double coverage on a high-value item. A policyholder's high-end camera was insured under both a home contents policy and a separate gadget insurance policy. After it was stolen, both insurers paid out based on their respective terms. The combined amount exceeded the camera's actual value, resulting in overcompensation beyond the principle of indemnity.
3.
Business interruption and reduced operating costs. A retail shop claimed under a business interruption policy for loss of income during closure after storm damage. The payout reflected expected pre-loss income. However, during the closure period, the shop's operating expenses dropped sharply, leading to a higher net financial position than before the loss.
4.
Replacement cost settlement on outdated home appliances. A homeowner claimed for fire-damaged kitchen appliances that were several years old. The policy provided replacement cost cover, so the insurer paid for brand new, top-of-the-line models. This effectively upgraded the home's appliances beyond their pre-loss condition, providing a benefit above actual loss value.
5.
Motor accident with aftermarket upgrades. A Matatu was involved in a road accident, damaging its stereo system and seats. The insurer authorized replacements, matching the pre-loss condition. However, the owner sourced cheaper aftermarket parts and used the savings to install premium speakers and leather seats, effectively improving the vehicle's condition beyond what the policy intended.
6.
Livestock insurance and market price fluctuations. A dairy farmer insured pedigree cows at the start of the year. Mid-year, one insured cow died due to illness. By this time, market prices for similar cows had risen significantly. The claim was settled at the higher market value, allowing the farmer to purchase a replacement of equal quality and still retain surplus funds.
7.
Crop insurance with dual compensation. A maize farmer insured their crop against drought under an agricultural cover. After a severe dry spell, the insurer paid a full settlement. The farmer also received a government drought relief payment for the same loss, resulting in total compensation exceeding the crop's actual value.
8.
Medical insurance and treatment package gains. A patient's medical policy approved a lump sum payout for a surgical procedure based on standard private hospital rates. The patient opted to have the procedure at a county hospital at a much lower cost, used part of the payout to cover personal expenses, and kept the balance. Topic 5. Consequences of indemnity profit. From the insurer's side, this risks breaking the indemnity principle of restoring, not enriching. From the insured side, it can lead to disputes or clawbacks if not handled transparently. Here are summarized consequences of indemnity profit. For the policyholder, the consequences include
1.
policy adjustments or premium increases. If insurers detect repeated or significant indemnity profit, they may revise terms, limit cover, or increase premiums at renewal.
2.
Reputational risk. In commercial insurance, a company seen to have gained unfairly from a claim may lose credibility with stakeholders or clients.
3.
Potential clawbacks. Depending on policy wording and regulation, excess settlement amounts may need to be repaid.
4.
Legal action. In severe or fraudulent cases, the matter can escalate to legal disputes or prosecution. Some of the consequences for the underwriter/insurer may include the following.
1.
Financial losses. Paying more than the actual value of the loss directly affects claims ratios and profitability.
2.
Regulatory scrutiny. Consistent overpayment may attract attention from insurance regulators, leading to fines or compliance orders.
3.
Market reputation. Perceived inefficiency in claims handling can damage trust with clients, brokers, and partners.
4.
Operational strain. Extra resources may be needed for audits, investigations, and process tightening, increasing administrative costs. The takeaway? Always document, agree on costs in writing, and ensure replacements match the pre-loss condition as closely as possible. Topic 6. Future of fairness. Innovation and transparency. The insurance landscape is evolving rapidly, and indemnity is no exception. The next frontier in claims fairness lies in technology-driven accuracy. Artificial intelligence, AI, and advanced data analytics are now enabling insurers to assess losses with unprecedented precision, from real-time photo analysis of damaged property to AI-powered repair cost estimators that automatically benchmark against market prices. This significantly reduces the chances of overcompensation or underpayment. There's also a global and regional push for transparency. In Kenya and across Africa, regulators are increasingly requiring insurers to clearly explain settlement calculations and share claim-related documentation with policyholders. This trend is helping bridge the trust gap, as both parties have access to the same facts and figures. For policyholders, the future will be shaped by clearer policy wordings, digital self-service claim tracking, and proactive communication. For insurers, it's about creating systems that are fair, consistent, and explainable, where every shilling in a payout can be justified. Actionable insight. Always review your policy limits, keep accurate records of your assets, and don't shy away from asking your insurer how a claim amount was calculated. The more you understand your cover, the less likely you are to unintentionally benefit from or be disadvantaged by indemnity profit. At the heart of insurance is fairness, making sure you're restored to where you were before a loss, without gaining or losing in the process. Indemnity profit, whether intentional or accidental, disrupts that balance and can have lasting effects for both policyholders and insurers. As the industry moves towards smarter technology, greater transparency, and tighter controls, understanding how indemnity works puts you in a stronger position to protect both your rights and your reputation. If you found this breakdown helpful, hit the like button, subscribe to Insurance World TV, and turn on the notification bell so you don't miss our next episode. And in the comments, share your thoughts. Have you ever seen a claim where someone ended up better off than before the loss? Let's talk about it in the comments.